7 Truths About Money That Banks Don't Want You to Know. Nearly a century ago, Henry Ford astutely observed that the lack of understanding among most Americans regarding the banking system was advantageous, as knowledge could ignite a revolution overnight. This insight remains relevant today, emphasizing the significance of the banking industry. However, it is important to recognize that banking itself is not inherently negative. It provides valuable services that have become indispensable in our lives. Securing our money is a common goal, leading us to entrust banks instead of hiding cash under mattresses or in backyards. Yet, it is crucial to acknowledge that banks generate substantial profits through complex and covert operations. Sometimes at the expense of unaware individuals, they capitalize on our financial activities, including borrowing, spending, and saving. Sadly, many people are unaware of the exploitation within the system. Bank stocks have become alluring investments due to their diverse revenue streams. Regardless of our perspective, we are interconnected with this banking system. 1. You're losing money every year. Keeping your money in the bank may appear secure, but it is important to understand that you are actually losing money each year. This is not due to fees or the risk of theft, but rather because of inflation. Inflation is the gradual increase in prices over time, resulting in the decreasing value of money. For example, something you can buy with $50 today will cost slightly more in a year and significantly more in 10 years. If you expect your bank account to maintain or even grow the value of your money through interest, you may be disappointed. While investors aim to keep pace with inflation, most bank accounts fall short. On average, inflation in the US is around 2%. But if your bank account earns a meager 0.05% interest, you're effectively losing up to 1.95% of your money's value annually. This applies to the funds sitting idle in your savings or checking account, not money you've invested elsewhere for returns. 2. Banks earn from your card transactions. Banks profit from processing fees when you use your credit card or debit card, which are often overlooked by customers. Retailers incorporate these fees into the sales price to protect their profits. For instance, a $500 purchase made with a credit card could result in a $15 fee for the bank, assuming a 3% merchant fee. This fee is passed on to you, the customer, as the merchant raises the item's price to compensate. Banks also earn significant profits from credit cards and can raise your interest rate with notice. It's important to pay attention to these notices and the complex language they may contain to avoid financial consequences. While credit cards have their benefits, it's crucial to exercise caution and avoid accumulating debt. Prioritize paying off your debts regularly. 3. Your money in the bank is not physical. Your bank account holds digital records of your money rather than physical cash. Banks utilize your money for various purposes, such as providing loans for businesses, cars, and houses in order to generate profits. During the financial crisis of 2008, many individuals sought to withdraw their money, but the banks did not have enough physical cash to fulfill everyone's requests. Banks can lend a portion of your money to borrowers using the technique of fractional reserve banking. Keeping your money in the bank, on the other hand, is not hazardous because it is insured, and the government is ready to act if any problems emerge. You may rest certain that your funds are safe with the bank. It is crucial to recognize that having money in the bank does not imply having it available at any time. Your money is actively working to generate profits for the bank rather than for you. As an individual, you have access to your money anytime you need it. If everyone wants to withdraw their money at the same time, it becomes difficult for everyone to get it. 4. Bankers are not your friends. Bankers may pretend to be kind, but it's important to remember their self-interest. They may interact with you individually, recalling special times and making you feel important. All of these, however, is part of a planned effort to acquire your trust. Their major goal is to meet benchmarks and keep their jobs. A banker buddy admits to employing this tactic, claiming to be on the customer's side in order to get them to take up unforeseen loans. Consider the possibility of unexpectedly obtaining a $50,000 line of credit card through this friendship with the lender. Their main emphasis is on meeting targets, and failure jeopardizes their career. Colleagues who actually cared about their clients and demonstrated compassion were fired for failing to meet expectations. When friendly bankers propose appealing offers, be wary. Prioritize loans that truly meet your requirements and objectives. False friendships can emotionally exploit you. 5. Foreign transaction fees. Foreign transaction fees generate profits for banks that are not always disclosed. When you use your credit card or debit card to make purchases outside of the United States, you will be charged additional fees. My friend recently returned after a 50-day trip overseas and found himself in this scenario. When he returned, he was surprised to find $105.05 in foreign transaction fees on his bank statement. Banks frequently conceal this information in order to prevent customers from investigating alternative financial options. Certain credit card programs, on the other hand, provide coverage in specified countries, exempting transactions from additional charges. Unfortunately, my acquaintance was unaware of such a program and lacked coverage, resulting in unforeseen costs. 6. Always check your accounts. Because your bank account is so crucial in life, it is critical that you monitor it on a daily basis. Without your knowledge, hidden charges may appear in your records. If you find any fraudulent charges, notify your bank immediately. If you report within 90 days, your bank is required by law to restore the money to your account within 48 hours. Your bank may try to postpone or avoid this process, but you are protected by law. Maintain your position as they are required to credit your money back to you. 7. You're being watched. Banks monitor your financial activities and are required to report any suspicious activity to the IRS in order to prevent criminal practices such as money laundering. Withdrawals in excess of $10,000 are reported to the IRS and may be scrutinized during an account audit. The IRS will investigate your tax payments as well as the legality of the transactions. Being aware of this monitoring might help you keep a clean record and prevent difficulties. That's it for today's video. Thank you for tuning in as we uncovered the secrets that banks don't want you to know about money. Now that you're equipped with this knowledge, you can take control of your financial future. If you like this video, be sure to hit like and subscribe to get updates when we upload videos about finances and life hacks. Have a great day, and we'll see you on the next one.